versus RIAs. Also joining us today, we have Carmela Ravi, who's a founder of Cornerstone Sales Consulting, an independent consultancy that works with RIAs to refine their sales processes for scale. We also have Kevin McDermott, who's principal of Kathmere Capital Management, an RIA with 4.4 billion AUM that's focused on wealth management and generational planning needs for high net worth clients, also an acquirer of independent advisory practices. And we also have our own Tom Kennedy here, who's a compliance director and attorney with 3ICO. He supports RIAs and served as TCO during his career for firms both being bought and sold, including a lengthy tenure at Ardent Asset Management as it was acquired by Aberdeen. We've got quite a bit to cover today, so I just want to jump right into it. If anyone has any questions during the presentation, feel free to put it into the chat, and we will try to address them as they come through. So first, just to kick things over to get started here to Kevin. Kevin, as someone who acquires advisory practices on a regular basis, what do you look for in a potential acquisition target?
Hey, Justin, thanks for having us. Carmela, Tom, great to be with you both. And thanks for all of you that are joining. First of all, I'm an advisor at heart. Advisors are entrepreneurial, entrepreneurial by spirit and in practice. We're going to talk about some things today to hopefully help you think about your business, build a better business, and then as a byproduct of it, have a business that's more valuable and that's more ready to exit. First thing you have to think about is your business is underwritten, right? And what are the sort of building blocks of how folks like us or other acquirers or other places you may desire to partner with and look at the stability of earnings, right? First thing to think about is there client concentration or no, right? Or is there a small group, 1, 2, 3, 5 clients that make up an overwhelming amount or a larger percentage than one would find attractive of your practice? Also, when it comes to stability of earnings, think about what your value proposition is. Is it more like a hedge fund where it's based on returns of a particular strategy? Or is it more advisory based where you feel like it's a more sustainable relationship on maybe the variety of things that you do for clients? Also, think about a clear number of rainmakers or key employees that an acquirer feels is pretty stable, happy to be there, and is going to remain there post-exit. Is it easy to identify tools, technology, processes when you think about, well, why would a client leave if I'm going to acquire this firm? Are they sort of state of the art? Are they up to speed with some of the more modern processes that are happening? Moving over then on not just retaining what you have, it's how do you grow? And this has a dramatic impact on your valuation. What's the track record of growth for your organization over the past 2 to 3, even 5 years? Is your marketing program pretty tangible? Is it pretty clear? Are you able to answer the question fairly well on where your clients of tomorrow are coming from that you may not have met yet? When you think about some of the marketing tools or marketing strategies that you have, what's in that toolbox? What's in that database on how you do what you do to generate activities moving forward? Could be strategic partnerships with law firms, with CPA firms. It's all these things that go into the marketing side of your business. Is there a really referable client experience? If you've been in this business a while, I've been doing it 25 years, your best introductions can often come from clients that are raging fans. So is your client experience something that you think creates future clients? And then, of course, org chart stability. If there's stars in your organization or if you're a star, vice versa, is that person or those people likely to be there and continue to produce that growth that they're currently producing? Could talk about all these things in great detail. We only have so much time today, but when you look at some of the building blocks of what makes up even those two areas and what makes up a great firm, think of scale. Are there pretty streamlined processes in investment management and client communication, in the client experience? Is it easy to generate scale through the use of key staff, right? If there is a ownership group, maybe a second layer of advisors, or just a group of principals, you share effectively where those CapEx expenditures of the future are something that you feel like you can handle, pretty easily. Diversification. I mean, I touched on this earlier, really, really significant, right? Diversification can mean a few different things. Number one, diversity amongst rainmakers. Is this a really founder-led, one rainmaker-led practice or registered investment advisory firm? How many practices are in the organization? Is there client concentration, like I mentioned earlier? Is this firm made up of just a few different clients, or even just a few different revenue producing advisors that may not, do things in tandem? And then are there strategic partnerships that are maybe fairly finite? And when you think about diversification, if you say, well, I get a lot of business from CPAs or from law firms or from vice versa, does that permeate the firm, or is that, really just one person within the firm? I think it's also important diversification is that do you cater well to certain types of clients, right? So catering to certain types of clients, I think, is important, that you say, well, maybe the $5 million household has a slightly different solution than a $20 million household. And different streams of income, right? Do you have revenue from private wealth management? Do you have revenue potentially from institutional 401k business? Maybe even fee for only for high net worth firms. Just very briefly on financial stability and balance sheet, are you low levered, right? Does it look like you have a CFO? Is it very easy to document expenses and revenue even by client, so to speak? And then financial operations, right? I mean, when you open up the books, is it very, very clear, how the business is run to them, so they feel like that they know your business as well as you do? Aligning of interest. When you go to an acquirer, do the key people, the key principals believe that you're with the right custodian, have the right technology, have the right programs, see the next 1, 3, 5 years the same way as each other? Very, very critical for people that are looking at your business.
Thanks, Kevin. And I want to move the conversation over to Carmela a little bit. Obviously, sales is the growth engine, the driver of advisory businesses, and essential to scaling for an exit. So Carmela, just maybe tell us a little bit, why is the sales process so important to building a successful advisor, and how does one build a successful sales engine?
Thank you for the question. It's a pleasure to be with you, Tom and Kevin. It's a wonderful team to help any people in the audience, the firms in the audience, they were thinking about the exit. So sales engine sometimes creates fear, sometimes creates doubt, but the sales engine is, using Kevin's words, a building block. Without a sales engine, you're kind of missing a good chunk of your foundation, obviously. So what I hope to accomplish for the audience today, in conjunction with Kevin and Tom, is to provide you some real life ideas and thoughts and insights and recommendations on how you can do that. One of the first things that I ask, there are 4 questions basically that I tend to ask, depending on who the client is. Number 1, is your sales strategy delivering results? Because if you keep doing the same things over and over again, getting no results at all, or very different results compared to your goals, you have a problem with your sales strategy. Do you have this foundation in place to scale effectively? Referencing back to, is your rainmaker the founder and you don't have anybody else, as an example? Are internal silos limiting collaboration and growth? That's a big one. That's probably one of the top ones in terms of challenges for RIAs scaling growth. And are your growth goals fully aligned with compliance requirements? And I'm going to touch on this. We're going to touch on this throughout the conversation today. So these are important questions that every RIA should start asking, because they could the answers or circumstances that could impact your ability to scale and the timeline for your successful exit. Keep that goal in mind. So today we'll explore how you can build a scalable sales engine that can reduce founder dependency, how you can create the culture, creating a growth culture that can demonstrate success wasn't accidental. The success of your firm, it's actually embedded and sustainable. Very important component for buyers. And positioning growth strategically so that buyers see the quality, the stability, and the momentum. So let's tackle the first top potential challenge. So one of the things that you may be asked is, okay, great, you've grown, you've shown maturity, there is transparency. What happens to revenue if the founder leaves, if you only have the revenue? The founder is the revenue rainmaker. So because some RIAs do rely on founder for bringing new business, this can potentially be an issue if you're looking to sell. And the reason for that is because, let's start with, the buyers want to see continuity. They want to see that there will be somebody continuing growing that revenue and continue on the growth. They want to see predictability. What can they forecast in terms of sales growth, and they want obviously to reduce the risk. If your revenues drop because the rainmaker leaves after the exit, well, there is a big problem there. What happened to the investment? Investment is almost gone. So you want to show scalability and that the revenue doesn't stop if the founder steps back, and therefore you can help increase the buyer confidence. So what I recommend is shift your mind and build a team, build a sales team, so that you're not depending on the founder. And this should be a separate discussion on how you build a sales team. But at the very bottom, at the very beginning, I should say, to build a foundation, you want to clearly define the roles, such as the business development, the client onboarding, account manager for client retention. And please, 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 you always do this in your everyday life. You have to document every step of the lead to close process, because you want to document and memorialize how you can continue on that.
So I guess I want to ask Kevin, I mean, I imagine it's a common problem when you're acquiring a practice, heavily reliant on a founder. Like, is that something that you as an acquirer can fix after the fact, or does that make it much more challenging from a valuation standpoint?
It definitely makes it more challenging. It's not impossible. It really depends on how engaged the outgoing founder wants to be, whether they bring an infrastructure with them, whether they want to build one during a glide path period. But certainly, I think, as Carmela said, that it's really important to start thinking about succession well before the time period approaches, because it's very much in the owner's best interest to bring to the table that succession, more than having part of the pricing and part of the valuation be the uncertainty of building that second layer below the outgoing founder and rainmaker, and then the associated risks that come with that. So anyone on this call, I mean, really think about making the investment maybe even before you have to in that succession, because it's going to come back to you in a very positive way. Not to mention, I would say it no doubt helps the client experience before even the exit, in having that support. Your clients might be thinking about it more than you are, depending on where you are in your work cycle anyway.
Yeah, that's an excellent point. Thank you for that, Kevin. Well said. So the next component that you might want to think about is, what do you need to have to scale your growth, and how to scale your building processes. And that's because it's not enough to create the first step, what we just discussed, but you want to show buyers how your growth happens. The revenues are crucially important, but I look at it as the revenues is the jumping off of the next step. But how do you get to the revenue increase? And the question is, can it be replicated? So you're really dealing with two separate areas here. And the reason why this is important is because when your processes are documented, as I mentioned, and transferable, then you are not selling just a practice, which you build with love, sweat, and blood, and everything else that you pour your heart into it, and you love the people you work with, but you're selling an enterprise. You have a sales engine that's fueling that enterprise. So again, I go back to document and implement those repeatable processes, because when it's time to have those discussions with the buyer, then you're going to need to prove where this is all coming from, and document at every stage of your sales cycle, from prospecting to the onboarding and anything between, the proposals, the client meeting, the qualification, and use technology, which I will touch on in a moment, because that's gonna help you create those checklists, those workflows, the playbooks. Again, think of being transferred.
That's helpful. So just in terms of the different metrics that buyers love to see, maybe you could just touch on that a little bit. And then kind of my question is, what is the acquirer really looking for when they're kind of getting that data during the due diligence process?
Right, that's for Kevin to touch on that. Sure. So matrix, well, who doesn't love matrix today? Whether you are from a previous generation or a future generation or current generation, you have to have matrix because they help you validate, and they help you validate, in particular with the sales growth, your predictability. Pipeline coverage, pipeline predictability is important. How you manage your pipeline, your close rate. Do you have any information? Do you have any matrix that can show your close rate, your turnaround time, your onboarding time, your retention rate? I mean, these are really, really, really important aspects of your matrix to do, and you need to track those matrix. So make sure that if you have any technology in place that can help you with this particular aspect of your sales growth, that your dashboard would have the ability to give you instant understanding of where you are on your sales growth, in the sales processes, on your opportunities, and you can export and run reports, slice and dice that data, so that you, when you're having this conversation with the buyers, you can actually quantify those metrics and you can eliminate that uncertainty, because the buyers, again, want to see how their future revenue are going to continue. So they will want you to demonstrate that.
Yeah, I think, Justin, if I could just add there, Carmela, that's absolutely true. I think when you look today in the industry, for those advisors that have been out doing this for a long time, you know that marketing today and the tools available for both the client experience and for marketing is dramatically different. And for someone that's looking to acquire, and when you're thinking about succession, you want to be able to basically trace that this is our client experience, these are our marketing tools, this is what our marketing tools produce in the form of activity, and then this is typically the success we have in as a result of that activity. So, there's so many different types of tools that I won't give commercials to now necessarily, that are wonderful sort of marketing and sales tools and that weren't available 20 years ago mainstream in what was more of a word of mouth business on the smaller end, that are now available today. And your ability to articulate the use of those tools in a documented way, the way that Carmela talked about, that leads to activity, that leads to new business, just makes you more and more attractive to an acquirer.
Yeah, absolutely true. So that is a great segue into a must for your growth is your sales stack and your sales stack integration. And it matters because, as Kevin just very well discussed, the technology proves your operational maturity as a company, your transparency. We are in the regulated world. We love transparency, and it definitely reduces the perceived risk from a buyer's perspective. But it also shows your sophistication and how ready you are to produce reports, to produce, during an audit, and so on and so forth. So you also want to have not only just a robust CRM, but the CRM should be able to integrate with other technology, your portfolio, your compliance. Please, don't forget about compliance, your marketing, your portfolio, and you leverage those CRM systems so that you can document and track the interactions, the opportunities, and you automate those follow-ups. You embed compliance during those checkpoints.
Kevin, is there something that you look for in terms of your sales tech stack? I don't know, percentage of revenue spent or something along those lines, or is it really just more on how you're using it, and you can be relatively tech agnostic from an acquirer standpoint?
Yeah, I don't think more is better. I think that it's being intentional, right? And it's being able to articulate that these are the people we're going after. These are the people that we think we best serve, and here's exactly how we acquire them. Some could be personal relationships through strategic partnerships. Others could be marketing through social media or the like, or other strategies an organization might have. But demonstrating that, Justin, and being able to make it extremely tangible, and make it an acquirer understand that if they didn't know you, more than 3 days ago, and you explained to them exactly how you grew your business, that they could get comfortable right away. And I think that goes from the client experience all the way through to marketing, because growing your business can come from clients, it can come outside of clients, and they'll be able to understand really the sophistication of how you run your business, really if it's an enterprise versus simply running a practice, and potentially running a practice as a longtime practitioner the way you may have run it 25 years ago.
Yeah.
And you're simply benefiting from a long time reputation more than something they can capitalize on, for many, many years to come.
Right. Correct. Thank you for that. And now, these are just some of the important items to really start building that type of scalable sales engine. There is a lot more to it, but let's start with that little, baby steps. But those are important steps. Now, in addition to your sales engine, we mentioned culture, and culture, everybody talks about it, but you really have to have a deeper understanding on how that can impact your growth and how you can build a growth culture within your practice or your enterprise. I rather think, long term. So the reason why this is important is because a culture that is proactive and of a proactive growth really tends to ensure revenue continuity post-sale, which what the buyer really is interested in, among other areas. So your culture can affect your continuity, your buyer's confidence, and your scalability. So think about, one way is we mentioned about rainmakers, Kevin and I earlier. Think about developing those rainmakers. So it's not just individuals. They're viewed as order takers. I absolutely despise this term, but I still hear it here and there. And I want every person, every firm that is attending today's discussion to envision and ensure that all advisors actually and actively generate business. So provide coaching, provide accountability, provide mentorship. But don't forget those individuals who may have the potential, but make them see that they're involved in that growth culture that you're trying to implement.
Yeah, and Kevin, those rainmakers, those non-founders who are instrumental to the growth of the company. I mean, how do you think about keeping those people on, after the sale to really maintain that valuation on a go-forward basis?
Well, I think even taking a step back, what Carmela said, the confidence the acquirer has in those second level rainmakers and service people will directly correlate to the value that they will give you, because they are the future. They are the ones that they're in some ways investing in to care for what they're purchasing, grow what they're purchasing. Certainly it's a math problem. It's a P&L on the profitability of a business. So you're hoping those people are well compensated. You're hoping those people that an acquirer doesn't walk in and say, wait a minute, there's John or Julie there, highly talented, big responsibility. They're not getting paid enough. And then that becomes an issue. There's also certain phantom stock type opportunities or ways that you can give those level folks an interest in your firm so that they live every day like an owner and they transact like an owner during that time, without necessarily giving away ownership to someone that you may feel like, if I don't go ahead and have an event in the next couple of years, I have to buy it back. There's ways where folks can do that. Organizations like us have a lot of knowledge in that area.
Yeah, absolutely. And I agree with you 100% on this, Kevin, because when you have misaligned incentives, they can create future problems. So you want to incentivize the right people, and you want to do it in a disciplined way. You want to have and show to your buyer disciplined compensation structures so that support the long-term value creations. Just as a thought, I've seen in the past RIAs really including the compensation, since we're talking about compliance shortly, that a percentage of the compensation was tied into compliance, adherence, and professional development. So you're incentivized, it's a carrot on the stick. So a very, very important component. And now that I mentioned compliance, but before we get into some question that I have for Tom, I want to touch on how important it is to have and to adopt a cross-functional collaboration among teams. That's when you break down those barriers. And the successful RIAs that I've seen also in my past life before I launched my company are those RIAs that really do not operate in silos. They have the compliance, operations, client experience, sales advisors, anybody in their team and in the teams must align. So the reason for that is because cross-functional collaboration really tends to ensure that those strategic decisions consider both the revenue goals and regulatory obligations. Let's not forget about that. So you want to prepare for a smooth transition and prepare for succession or M&A. So there are 4 key components, key strategies that I tend to recommend is shared goals, unite the teams around client retention and revenue, regular communication. My God, please, that's the big word, communication. Break down those silos with consistent touch points. Integrated tools, we touched on earlier, Kevin and I, centralize the data so this decisions can be made in a smarter way and a more effective way. And empowered teams, encourage those cross-departmental input. But that also brings me to a next level of building this culture growth, which is I call it a leadership readiness. And because the ultimate, one of the questions that the buyer is likely to ask, and it will be front and center, is who's going to run the firm when you leave? I'm talking about, the C-level. So what you want to do, you want to develop, train the successors. That's important. Train your successor or your successors. Make sure that your client knows about them, and you have to trust them so that clients can trust them. You cannot lose trust during this process of purchase and post sale. You have to continue that line of trust and document the leadership succession plan. So include, identified who is going to make decision, who has decision-making authority, transfer those authorities, who manages operation, who oversees compliance. Make that very, very, very clear, and that's important. But this also brings another aspect about that the breaking down of the silos, which is sales and compliance, what I call the sales and compliance partnership, if I can call it that. And it is that, it's a partnership. So make sure that you have embedded compliance throughout your sales process, because it's going to drive efficiency and it's going to build trust. I had a whole seminar last week about that. And one of the most effective ways to create alignment is to really embed compliance directly into your sales process. Not at the end, not as a final sign off, but really up front throughout the conversation. And please, 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 you can reach out to me afterwards, but I can talk to you about how you can turn compliance into a growth advantage. And this brings me to my question to Tom. Tom, how can firms embed compliance into daily operations so it actually adds value instead of being a checkbox exercise, excuse me?
Sure. Thank you, Carmela. It's great to be here with you and Kevin and Justin. The primary value that a good compliance team, as well as your legal counsel, can add is to sort of be embedded in all the different processes, as you mentioned, things like being parts of supervisory committees, teams that look at new business development, look at new product development. Technically, the skills that these folks have will generally be what the regulations are, and they'll also know a little bit about what each of the firm's functions do and can anticipate problems before they come up and make sure that when product launches or new business initiatives happen, that you don't run into issues at that time. You want to be able to think about them in advance. The other piece that is, very sort of important to managing the overall health of a firm is to have the compliance function sort of perform like an audit function. It's not just at the time we build a function that we want it to be, working in accordance with legal and regulatory standards, but that, that it continues to run. So let's say a year or 6 months after the implementation of a new process, the compliance team can come in and check and, do a test to make sure that that function is still working. In particular, if it's something that the SEC or another regulator requires of a firm to do when a specific business activity is involved. And I guess the last thing that I always think of is that people who have like compliance and legal skills, they often have a different set of viewpoints and, see things from a different angle. It's another set of eyes. If folks who are focused on a business, development issue or a business growth issue don't see the risks that could come from that type of activity, sometimes it's, you become the adult in the room that, says, hey guys, slow down. Maybe we should think about this a little more before we jump into it.
That's right. Perfect. And we could give examples over examples about how that works very well, but we'll put a pin on it for now. The third pillar is now that you have the a sales strategy in place, you're building a culture of your growth culture. Well, then how do you position that growth to get the best value? So let's talk about it a little bit on how you can do that. And you can do that by building a story, your growth story, because what buyers are looking for is they want to prioritize the quality and the stability of the revenue. So you really have to have the components in place to be able to build the story. The first one that I see is crucially important is your client segmentation strategy. And actually, Kevin alluded the first on the first slide earlier. You want to focus on the client that are high value, the clients that are scalable, and you want to allocate those resources accordingly. So do a segmentation by profitability, by AUM, by growth potential. Let's not forget service complexity and your strategic alignment. And I know from experience, many years working with the RIAs whom I love deeply, when you're first starting out, you want to service, you have a goal, you have a focus, but sometimes, you may tend to add a lot of different types of cookies in one jar because you want to please everybody. And this is an issue that's coming up, and I've heard from other individuals in this space. But as you grow, if you want to show maturity, really identify exactly what is valuable to you and how many resources you want to allocate accordingly, because each client requires resources. So something really to think about.
Yeah, and just a question for Kevin on that. We talked a little bit earlier in terms of metrics for sales metrics, but in terms of profitability metrics on a per client basis, I mean, how important is that to you, Kevin? That a firm ready to sell kind of comes to you with that information in hand?
I think it's really important. I think it gets back to that, feeling like you have a CFO and understanding how efficient are you in your acquisition of new clients. There's many different ways in this world to grow. In some ways, you could use outsourced marketing programs that can be quite costly in the hope of bringing in revenue. You can have a thriving client base that is very high end on referrals, or something in between. Justin, having those numbers readily available to making an acquirer understand how you run your business and what the cost of new business is and how your particular operation runs is critical. And those metrics should be somewhat readily available for an acquirer to be able to detail somewhat how profit margins work, unrelated to what markets do to your revenue, but more related to what is really the margin on a new client based on how we run the business internally and what it takes to acquire that client. Being here in Philadelphia, do we run commercials during the Eagles game? I know that's expensive. RIAs don't do that, versus word of mouth marketing. Critical to an acquirer to understand that, and for a business to be able to show that financially.
Yep. Perfectly well said. And it ties back into, it comes down to revenue quality versus quantity, and where you want to allocate your resource. Another aspect, there are two more items that I would like to share. One is RA should not overlook brand and messaging and alignment, and it ties back to what Kevin and I have been talking about, not only bringing down those silos, but also communicating internally, having those cross functional team working together. Make sure that marketing, sales conversations, proposals, client communications, your advisors have the same value proposition consistently, because your buyers are going to look at that, and it will be easier to do the transition, because it shows a cohesive message across the board and your market position. And therefore, that can help you bring your story. Don't forget that a key strategy is a storytelling for the exit. Prepare a narrative that goes beyond the numbers, highlight growth trajectory, future opportunities, retention rate. I keep going back to that. pipeline health, and really a cohesive story of your message, of your market position, of the story of how you grew, how you became today, and how you're ensuring that it will continue to grow, because buyers will pay attention, and will pay attention for momentum, for strategic positioning, and predictability, all of which can help increase your valuation.
No, I think that's an important point. I would recommend for any aspiring, professional or RIA, have a timeline. Go back 10 years or however long you'd like to and say, back in 2015, we wanted to do this. We made this investment. We made this hire. This is what resulted. Then in 2019, we did this. In 2022, we did this. A track record of where you were. That clear line of sight is critical to an acquirer. And it does a phenomenal job of telling your story. It also does a phenomenal job of letting them know that you are very much in this business, that it encompasses who you are, and that you have a vision about what you're trying to do. They want to partner with people. We want to partner with people that don't necessarily want to just exit stage left right away, but someone where this business has been a part of their life, and they feel like this is the right thing to do with their business, but they care about their business, and they can show that.
Yep. Thank you. Absolutely true. Thank you, Kevin.
And Kevin, just in terms of brand messaging, just one more question on that. How many does it make sense for a selling firm who has a particularly strong brand? Like, would an acquirer consider possibly keeping that and keeping that enterprise live, just given the strength of the brand, or are some going to just automatically subsume it within the larger company?
Yeah, it's a great question. We are all entrepreneurial by spirit. We've all built these businesses. Sometimes we hate to give up the name.
Yeah.
Who you marry in this space needs to fit for you. There are going to be some acquirers that want you to become ABC Financial. And there are other acquirers that are saying, we are allocators of capital into high growth, successful firms. Keep doing what you're doing, you and your team. We want to make an investment in you. So I think, Justin, that's really dependent. And I think the more you're offered by an acquirer, if you want to continue to grow, the less important it is for you to keep your name, because they may offer you things that you can't build on yourselves. But all things being equal, there are many entrepreneurs that built Justin Financial and say, I really want to keep that brand. It means a lot to me. And still, potentially take this step. So there's no clear answer to that. It varies on who you're talking to.
Absolutely true. Yeah, absolutely true.
So Kevin, maybe you could just tell us a little bit about, kind of some of the variation that we've seen over the last few years in terms of different people selling their practices, and kind of what that looks like from a valuation standpoint.
Yeah, and one thing I want to say is you're hearing a lot today as a practitioner, and everyone on this call is successful, no doubt, who's listening. So I think the one thing I would tell you is if you are hearing things and you're saying, you know what, I want to take that next step in my practice, it can happen one step at a time, right? We talked about so many different topics, from financial to compliance to marketing to how you treat team members, all critically important. I think what you're looking at here is sort of the hierarchy of valuations, right? Like, how does the industry, Kathmere and other people, view a business, and what type of multiple would you expect, right? So to the lower left here, looking at an individual advisor practice, small or large, that is really somewhat your broker dealer affiliated independent advisor, right? Oftentimes with a high payout, right? Pretty thin org chart, not a tremendous amount of value on a sale. Could be a combination of brokerage and fee-based revenue, difficult to underwrite, smaller practices, just often harder for an acquirer to sort of sink their teeth into. When you move over to the small RIAs and even large RIAs, what you really have there is you have, prior, when you leaned on the broker dealer for so much support, you've really built a real business. I mean, a lot of this stuff comes in-house. You have a P&L, the staff, the payroll, the technology, the compliance, all that now comes to you in a variety of different ways. It is a favorable type of revenue in the registered investment advisor space for an acquirer to look at, right? It's only really one type of revenue, and that's fee-based revenue. The challenges, of course, for the folks or the individual running those businesses are, you're running a practice the way you always were, but now you're really running a business. And that creates complexity that ultimately needs to be addressed. I think what you're starting to see today, though, is this enterprise RIA concept, where it's so obvious from the beginning that this organization is so far beyond the owners, the founders. It's really clients that come in, may not know who the founder is, may not know who owns the place. They don't care. They want the client experience. And even quite frankly, the folks that have been there for a long time, I could speak for us at Kathmere, hire us for our team and our client experience. Don't hire us because you want to be my friend or we've known each other a long time. It's well beyond that. There's clarity and succession, right? Carmela talked about it's documented. It's documented clarity of succession. Typically, these businesses are pretty highly capitalized. So they'll have banking relationships that they can lean on as it relates to dealing with maybe new acquisitions or CapEx expenditures, just a different type of organization than maybe a smaller an RIA handling, a couple $100 million to a larger one, maybe between 500 million and $1 billion. I think in an enterprise RIA, valuation sort of permeates the firm, right? That I think people understand that this company has a value, there is succession plan, and everybody has a bit of a vested interest. You'll often see committees. There's a compliance committee, there's a marketing committee, there's an investment committee, and there's different people on each committee at an enterprise RIA that gives it that real business feel to a prospective advisor looking to join, maybe to a client as well. And then one unique thing you're seeing also, Justin, is you're seeing sometimes this currency aspect where you can partner with an enterprise RIA, you can sell a piece of your business or maybe not that much at all. But that enterprise RIA always has the ability for a practitioner within it to sell parts of their business at the moment of their choosing. And also the ability for them to potentially remove their business with ease. And I think that's really favorable to a lot of people that are thinking about taking this step. So the more you go from left to right on that previous chart, the more you're going to see a valuation increase. What you're looking at here on this chart is simply, these are the lifetime achievement awards of companies that have really lived out everything you're hearing today and in a very public way have enjoyed those valuations. Now there's hundreds of RIAs not listed here, which trade at 13, 15, 17 times. There are some on this list you've probably heard of. I would say United Capital and Goldman Sachs is probably the most well-known one. So, I don't have any stories about these particular organizations other than to say for everything you've heard today from Tom, from Carmela, from myself, is that all those things permeated these organizations on how they ran compliance all the way through to the client experience, marketing in between.
Thanks, Kevin. And I'd like to just turn it over to Tom now. Let's say you've done all these things that we've talked about: sales, growth, technology, compliance. Now you're kind of at the point where you're having some conversations with people. Tom, you've sat on kind of both sides of that transaction. How do firms best prepare for success during the acquisition process?
Sure. Thanks, Justin. Yes, I have been on both sides of this in my career, and I'll share some of the things I've learned along the way. So an RIA that's a potential acquisition target should be seeking to ensure that you understand the acquisition process. RIAs, when they're being acquired, just like any business entity, there's going to be contracts, due diligence issues that need to be identified and addressed. And preparing for this in advance to undergo an extensive M&A due diligence by the acquiring firm and its counsel or other agents can lead to a better outcome. So there's some steps that you can take. I think the first thing is, before even due diligence begins, you should consult with counsel to understand the legal process that's going to be involved in having your firm get acquired. I would say consult an attorney or a firm that has both investment management lawyers as well as M&A space. And if you can find somebody that knows both space, that's the guy to go or the gal to go with. This is important because attorneys who know the investment management space don't always know the issues involved in selling a firm, and vice versa. Folks that know M&A don't always understand the investment management business. As I go through some of these points in the next couple minutes, this is going to become even more apparent as to why that's important. So one of the aspects of an M&A due diligence is that the buyer will undergo what's typically called an operational due diligence, whereby the buyer is going to be looking to confirm and the seller is going to be looking to demonstrate that you have a robust and transparent business infrastructure, all the things that Kevin and Carmela have been talking about for the last 45 minutes. You want to be showcasing your strengths and the scalability of your firm's operations and all that other back office stuff, compliance, technology, operations, trading, portfolio management. Effective preparation involves an internal review or an external provider to help you prepare and identify and address any weaknesses before this buyer or an investor does. Your presentations and your sales efforts are going to be what attracts the buyer. The weaknesses in your back office is how you can end up losing a deal. So let's talk about it. How can you prepare? You can conduct these internal audits. You can do mock audits. Sometimes what's called mock audits in the compliance space. You can hire consultants to do this. So for instance, you can have a compliance consultant come and look at your compliance program. You can have technology folks look at your cybersecurity program. Firms like ours, we will do operational due diligence for this purpose, or we'll actually help you prepare for it. One thing to remember is also to ask your insurance carrier. Sometimes your D&O or E&O insurance policies will have incentives for you to do these things, and they'll give you breaks on the premiums that you have to pay, or actually help you pay for it outright. These reviews are also going to have you look at your firm's finances, compliance, operational workflows, your technology stack, your HR policies and procedures. It's going to cover all the topics that Kevin and Carmela covered: operations, organizational structure, human resources, business continuity, the efficacy of your compliance program, the competency of your compliance and legal support, you name it, regulatory, disciplinary history, so forth down the line. What do you do when you have completed these reviews? Well, the key thing is to resolve the issues proactively. Make sure that you've addressed all the issues that, if you have lawsuits, for example, that have been out there, see what you can do about closing those out, settle them, figure out how to make them go away so that they're not something that needs to be addressed as part of the due diligence. You have regulatory enforcement matters, deficiency letters from regulators. Make sure all of those things are buttoned up nice and neat. That's another thing that our firm can help you with. Proactively resolve these issues. This could mean updating your policies and procedures, your compliance manuals, improving your data security, formalizing employee training programs, you name it, adding additional insurance, hiring new vendors. There's a lot of different ways you could do it to get ready.
So Tom, what are the kinds of documents that can be helpful to a firm as they're preparing for an operational due diligence review that can help the firm kind of just tell its story, and how can compliance and legal help?
Yeah, sure. So the best advice I can give you is prepare your responses in advance. Don't be, knocked on your heels when you're asked for information about how things work. For example, use a standard DDQ to proactively respond. Make sure that you're, just like as if you were courting an institutional investor, DDQs can be very helpful. Work with your counsel or compliance team to make sure that the questions you ask have the technical relevancy to the questions that the buyers are likely to ask, as well as the answers, and make sure the answers are accurate. The information provided in these documents is critical because it has to be fair, clear, and not misleading. It should include any disclosures or notes without which these pieces would be misleading. Misleading information in this context can lead to charges of fraud or litigation after the fact if people rely on the representations you make. Once you're closer to having your due diligence begin, you should be asking counsel for input on creating what's called a virtual data room. This is just a term that's used in M&A to basically, it's a database where you can give access to the buyer and their counsel and their agents that they use to do the due diligence for all the necessary documents to be requested, organized into clear categories like legal docs, compliance docs, financials, client data, technology, HR, you name it. This will streamline the process and let the buyers and their counsel know that you're serious and that you have the organizational ability to sort of present your best foot forward. And the other thing that you should do is practice the delivery. This is just like any other sales presentation, probably the most important one you ever had. Prepare management's presentation. In addition to your DDQ, have a narrative of your firm's operational strengths, highlight how your processes, your compliance, technology drive efficiency, practice it. just like Carmela has been saying earlier. And then from the compliance perspective, I always like to add this, and I think Carmela pointed this out as well, be transparent.
Yeah.
Deal with your challenges and weaknesses. Make sure that during this presentation or review that you're forthcoming. Practice the delivery so that there's a proper weight and emphasis provided onto the strengths, but make sure that you present the weaknesses in the light that, your plan for how you're going to fix those weaknesses, why they don't present the risks that they may otherwise seem like. This transparency is going to build trust with your acquirer. The worst thing for a deal is for them to think that you're trying to hide the ball. And that can lead to a smoother transaction. Just a couple of other points I think it'd be very key, and there's no way in the time that we have left that I could cover all of this, but you should understand the legal process that's going to be involved in being acquired. Things like understanding what a letter of intent is going to include, understand what a purchase agreement is going to include, understand that client consents are going to be required in order to sell the firm, understand your closing and post-closing issues, and make sure that all those conditions can be met. Let's also keep in mind that when an advisor leaves a firm rather than sells the firm, it's a whole different set of legal issues. There's non-compete and non-solicitation clauses. There's confidentiality provisions. There's notice period requirements. There's FINRA rules if you're a part of a broker-dealer. And another very important thing to mention is the broker protocol, where you can't sort of solicit your clients until you've actually resigned. And there's a whole process there. Hire the right attorney that can advise you on how to navigate those processes, and you'll have a much smoother sale.
Thanks, Tom. All right. Well, we're coming up to the end of time here. I did want to give everyone a chance to ask any questions if you have in the chat. But otherwise, you can access the link that you used to get into this webinar. That'll remain active. If you want to rewatch this again, we'll also post it on our website. You can reach any of us here for sales or compliance or advisory questions. We also have our affiliated law firm, Royer Cooper Cohen and Braunfeld, that can help out with any sort of legal matters, including mergers and acquisitions. And I'm not seeing any questions. But I just want to thank everybody, thank our speakers today, Carmela, Tom, Kevin, and thank you everyone for attending.
Thank you. Thank everybody. It's been a pleasure.
Thanks, everyone.
Thank you. Great being here.
Thank you.
Appreciate it.